This is Trading Techniques Lecture number 545. Our goal in this tape will be to finish up our discussion of the new Barometer and OP indexes. Before getting to the new material, however, let's make a brief review of what has already been covered. In Part 1, the main topic of discussion was the weekly Barometer indexes. You should remember that these are primarily intended to be tools for the long-term investor. Their purpose is to help point out the most important turning points in market action. This is desirable because the long-term investor does not make his profits by getting in and out of the market on a frequent basis. Instead, he is looking to hold on to each position that is taken just as long as possible in an effort to squeeze out as much profit as he can. Therefore, knowing which turning points are likely to be the most important can be a tremendous help in reaching his goal. The short-term trader can also make use of the weekly Barometer indexes. This individual has no intention of holding his positions as long as the long-term investor does. In those instances where a self-proclaimed short-term trader finds himself holding long-term positions, it is likely the result of failing to admit an error in judgment and not an effort to secure long-term capital gains. What makes the weekly Barometer indexes of value to the short-term trader is the importance of the turning points and that they tend to indicate. If a turn is of enough significance to cause a long-term investor to go into action, then at least part of the response to that turn should produce a worthwhile opportunity for the short-term trader as well. The one thing the short-term trader has to be careful of, though, is the exactness of his timing. A long-term investor can take action in the final phase of an advance or decline while the market is still some distance from its absolute top or bottom and come out with a good profit. The short-term trader does not have this degree of flexibility. The time window in which we can justify action is much smaller. Therefore, in using the long-term indexes, he must have the patience, or attempt to develop the patience, to wait as long as possible before making a move. Sometimes this will result in missing an opportunity completely, but this is far better than being too early. The last indication that the market was approaching a turn of long-term significance came on Friday, September 25th, after 3 months of aggressive downside action. The stocks to buy at that time were those that had already shown signs of bottoming out. Now, some 5 months later, the market is testing that September low. The weekly Barometer indexes are not yet indicating the likelihood of another important turn, but that could change in just 1 week's time. If or when it happens, the stocks to give the greatest consideration will be those that remain relatively strong. These will again be stocks that have already shown signs of finding a bottom and which have found that bottom at a higher level than was the case back in September. In Part 2 of this discussion, we considered in detail the new indexes for the individual stocks in the Wyckoff wave. These are tools of value mainly to the short-term and intermediate-term trader. In this section of our investigation, we found that most of the time the relationships that hold true for the general market indexes also apply to the individual stock indexes. The one notable exception here are the force indexes, the character of which is strongly influenced by the average volume of the stock. With both these individual stock indexes and with the weekly Barometer indexes, there is much wisdom in avoiding mechanical application. These indexes can confirm the desirability of taking action, but it should be the passing of buying or selling tests that point out a potential opportunity in the first place. Anything else either borders on or is a mechanical application. The principal problem with these is that they tend to get you into a situation, but then seldom get you out before it's too late. In Part 3 of this study, what we want to do is see how the various aspects of what has been covered in the last 2 tapes can be integrated together with market analysis to result in a plan of operation that is manageable and which achieves the desired results. To do this, we will depend on case studies from recent market action. It should be noted that most of the examples we will be covering are especially short-term in nature. This is not a function of the indexes, but rather of the market's action. Since all of these examples are taken from trading range activity, the moves are more frequent and smaller than might otherwise be the case. However, if profitable trading can result here in what has to be the most difficult type of market operation, achieving similar or better results during other types of market action should be easier. Before actually beginning the case studies, let's lay out some ground rules of things that should and should not be done. First of all, the basis for concluding that trading is warranted should come from price and volume, as well as figure change activity. Indications from OPs and barometer indexes should be used only to confirm price and volume relationships. Never trade a stock against the market. Also, never trade a barometer or OP indication against a price and volume indication. Always use buying and selling tests in an effort to avoid premature action. With these points in mind, we can move on to our first case study, which begins with the picture of the market after the close of trading on Thursday, November 19, 1981. This discussion will involve a substantial number of charts. In order to keep the number from getting ridiculously large, most charts will be printed only once, with action that covers all of the case studies being shown. To derive a maximum benefit from the discussion, it would be desirable to cover up all of the action to the right of the particular day being considered. This will help add a greater sense of realism. On November 19th, the market was in the unusual position of having three trends in progress at once. The most important trend was, of course, the relatively long downtrend based on the supply line, connecting the high on June 15th and the high on August 12th. This line had been respected as recently as November 12th, just 1 week prior to the day in question. The second trend of importance was the trading range that developed out of the oversold conditions surrounding the selling climax. As of November 19th, the market had worked its way back to the lower region of the trading range. This is one of the areas where the taking of long positions can be justified, although a spring action on the support level would provide a more clear-cut indication. The third trend was an uptrend defined by the support line connecting the selling climax and the first secondary test of the climax. It should be noted that the action of November 19th and just prior to it suggests a second secondary test, and one that appears to be respecting the support line of the newly defined uptrend. This can be seen as a positive sign. With three trends in progress at the same time, one might think that the result would be total confusion. This need not be the case. When the market makes an important turn, there is likely to be a particular day that can be pointed to as being the one on which the turn actually occurred, although this usually cannot be done with a great deal of certainty until some time later. What is easier to determine is when the market is in the process of turning. This is because such action takes time to complete, which provides the trader with more of a chance to catch on to what is happening before it is too late to do anything about it. During a turning process, it would be very rare to see one trend, such as the downtrend in this case, all of a sudden give way to an uptrend defined at the exact same moment that the downtrend was broken. What would be more normal would be for a downtrend to evolve into a trading range, while the downtrend still is exerting some influence on the overall situation, and then for the trading range to evolve into an uptrend while still maintaining an influence. That appears to be what was happening on November 19th. Therefore, since the market was well into the turning process, giving some consideration to the possibility of taking a long position could be justified. Now, let's look at some of the buying tests. First of all, do we have signs of preliminary support and a selling climax? The answer is yes. Has the downside objective been fulfilled? Although it cannot be proven from the charts included with this tape, the move down to 2120 did fulfill the objective of one phase in a major down count, the final weeks of which can be seen at the left side of the chart. The remaining phase of this count is a potential problem for the future, but it should be remembered that in working with the major counts, the reaching of the objective of any one phase may represent the end of the move. Therefore, we do have some justification for believing that the buying test of a fulfilled objective has been passed. This justification is stronger when the situation is viewed from a shorter-term perspective. The 5-point figure chart shows a count across the 2275 level, indicating an objective of 2160, which had come to within 3 points of being reached at the low on the 19th. Another test that would need to be passed involves bullish behavior. In determining this, the actions of greatest concern should be the reaction from the top of the automatic rally to the bottom of the secondary test, the rally that followed the secondary test, and the reaction down to November 19th. To be considered bullish behavior, it is necessary to have higher volume on rallies and lower volume on reactions. Does the action qualify? It must be said that it does not represent a striking example of bullish behavior, but at least it does not represent a total failure. The volume on the move down to the secondary test did not really decline, but rather held constant at a moderate level. The rally that followed did bring an increase in volume, and that volume did begin to fade as the second test progressed. Therefore, as of November 19th, it can be said that this buying test was being passed, although not in classic fashion. Another important buying test is that there be potential to justify a worthwhile move. If the low at 2170 on the 19th was going to be taken as a last point of support prior to the beginning of an important up move, two possible upside objectives existed. One took the count over to the secondary test for an objective of 2340, and the other took it all the way back to the selling climax for an objective of 2660. The 2660 figure is impressive, but it is not the one on which to justify a trade. We have to begin with the most conservative objective, in this case 2340. If a position can be justified based on that, then the buying test can be considered to have been passed. Taking a position in this case with a 3-to-1 profit-risk ratio would have resulted in a stop being placed just below the level of the selling climax, which should have represented a high degree of protection. Consequently, we can say that this test had been passed. Thus far, the case in favor of a long position on November 19th appears to be quite strong, but it is not perfect. Another test to be passed before going long is the development of a pattern of higher bottoms on reactions and higher tops on rallies. On this point, we have to conclude that the test had not been passed, or had only been partially passed. The pattern of higher bottoms was in place, but clearly a pattern of higher tops was not. Therefore, we have a problem. The problem of lower tops failing to confirm the pattern of higher bottoms resulted in an interesting situation. An apex was forming, which normally tells us that something is about to happen very soon. The question is, what? To that point, the course of events had been on balance. The one negative development that had occurred was partially responsible for the indication of very immediate and significant action. Therefore, its significance could have been discounted somewhat. There was another problem, however. An important buying test says that the supply line of the previous downtrend should be broken. Clearly, in this case, it had not. In fact, only a week earlier the line had been tested and it held. This presents a problem that should never be discounted. This failure could justifiably have been used as a reason to wait. Those who wait for everything to be just right seldom, if ever, get hurt badly. Usually their profits are quite good. These individuals do not trade very often, however. There is nothing wrong with that, but it is a fact that most of us like to look for a greater degree of activity. For many, this urge to trade is a continuing source of losses, but this can be corrected by confirming the desirability of an intended action before actually making the move. As we have already seen, the situation that existed on November 19th was not perfect, but it did appear to have some promise. To justify acting on that promise, we should look to the OP and the trend barometer for confirmation. The OP could provide confirmation by being in divergence with the wave. In this case, the wave was higher than it had been at the reaction lows on September 28th and October 29th. The same was true of the OP. Therefore, no divergence was in effect and no confirmation was being given. The trend barometer, however, does provide confirmation. The most positive condition for the barometer includes three elements. The first is that the technometer be oversold. The other two are that the force and momentum have turned upward. All three of these elements were in place on November 19th. Therefore, it can be said that the desirability of taking long positions, or at least a long position, was being confirmed. The distinction between taking one or many positions is made here because of the imperfection of the overall situation. Occasionally we will come upon a set of conditions that warrant major commitment. Most of the time, however, positions should be taken in stages. The situation on November 19th fell into this second category. Having decided that one or more long positions could be justified based on the conditions that existed, and having confirmed that the conclusion with the action of the trend barometer, the next step is to find, or at least try to find, a stock that can be traded. There is an important point here that should not be overlooked. Each of us can only monitor the actions of a limited number of stocks. Therefore, given a set of market conditions that suggest action, it might not be possible to find a stock in which to take that action. From among those under current consideration, the stock has to be as positive as the market in order to justify a trade. Otherwise, the result will be a trade in the wrong stock at the right time, which may not have as disastrous an outcome as would the wrong stock at the wrong time, but the results will certainly be much poorer than they would have been had the right stock been chosen at the right time. The desire to find the right stock or stocks may serve as the reason for following an enormous number of stocks. The thinking here should be obvious. If we are watching a very large group of stocks, the odds of having a good stock in that group are improved. While this is true, it overlooks a critically important point. Since time is always limited, an increase in the number of stocks being followed decreases the amount of time available to study each stock. This increases the likelihood of missing important developments, which defeats the purpose of watching the larger group. Most people can only carefully study 20 to 30 stocks on a continuing basis. When we at SMI restrict ourselves to a careful study of just the stocks in the wave, we are perhaps being more restrictive than anyone listening to this tape may want to be, but there are reasons for doing it. One, of course, is very limited time. The more important reason, though, is that an indication given by the Wyckoff wave has to be reflected in at least a few of its component parts. If it isn't, then there is a good reason to question the initial conclusion. To find the stock or stocks in the wave that could have been bought on November 19th, we should begin with the relative strength and upside potential. These are the easiest examinations to make, and making them will immediately eliminate those that should not be seriously considered. In this case, we have three low points, one on September 28th, one on October 29th, and one on November 19th. These are at progressively higher levels. Any potential long candidate should have this same pattern. Only two of the stocks could have survived this test. They were General Electric and Exxon, with Exxon just barely qualifying. The first test tells us that Exxon and GE were at least as strong as the market, or perhaps stronger than it, on November 19th. The Wyckoff method directs us to only buy stocks that are stronger than the market. If we compare the charts of Exxon and General Electric alongside the chart of the wave, it is clear that only General Electric was truly stronger than the market. This would have eliminated Exxon from consideration. There is another way in which Exxon could have been eliminated. It would have been through a comparison of the upside potential in the two stocks. From where it was on the 19th of November, Exxon had an upside potential of a little less than 10%. The potential in GE at the same time was a little more than 16%. General Electric obviously represented the better opportunity. At this point, we probably could have convinced ourselves that General Electric was the stock to buy. However, if we wanted additional confirmation, we could have found some. The stock's price and OP were not in divergence. Rather, they were in harmony on the upside, which is a condition that will usually aid continued efforts at upside progress. Another important factor would have been the oversold condition of the technometer, in combination with a force index that had stopped going down. The 4.5-point move in the stock that followed would have produced a worthwhile profit in the January 55 calls, which is probably the vehicle that most taking advantage of this opportunity would have used. The second case study we are going to examine is a situation that existed on December 2nd. At this point, the market was culminating its response to the set of conditions that had existed on November 19th. On December 1st, several important things had happened. One was the reaching of the previously mentioned upside objective of 2340. This resulted in the passing of a selling test. Another was passed by the breaking of the short-term uptrend. Another important development was the creation of an oversold condition on the technometer. It should be noted on this point that the force and momentum were continuing to move higher, which prevented the situation from being as negative as it could have been. On December 2nd, the force and momentum turned down, but the technometer lost its overbought condition. Neither the first or the second exhibited an optimum condition, but together they indicate that something was wrong with the rally. A final development worth noting about the action on December 1st and 2nd, and the one with the potentially most negative consequences, was the upthrust action created by the penetration of the resistance level at 2335. Although not shown on this chart, the action of the next week and a half brought two tests which tended to confirm the upthrust, because on both the attempt by the wave to advance was stopped. By the time of the second test, which was of special significance because it came on decreased volume, the potential was in place for a 120-point decline. Going short on December 2nd would have been difficult to justify, even though there was an upthrust action. This is because of the absence of a test and the lack of a clearly defined downside potential. However, the problems that were developing at this point could have been used as a reason to lock in short-term profits on the long side, and to identify potential short candidates to trade in the event of a successful testing process and the development of some downside potential. We can see that on December 1st, the wave was just barely making a new high. Therefore, in looking for a potential short candidate, we would not want a stock any stronger than this. Certainly, we would not be interested in any stock that had made a definite break above the top of its trading range. Using this as the first step in the elimination process, 3 stocks, Exxon, General Electric, and IBM, would have been out of the running immediately. The other 5 for one reason or another, could be seen as potential candidates. With such a large percentage of the stock surviving the first elimination step, we are perhaps being given a clue as to the overall lack of health in the market. It is unlikely, though, that more than 60% of the stocks under consideration would actually be good candidates, so there is need to apply the second step. When we do, we find that General Motors is eliminated because it has no clearly defined downside potential. The other 4 stocks do, but the magnitudes of those potentials vary considerably, from 20% for Union Carbide to 29% for Merrill Lynch and Pittston to 50% for UAL. These numbers clearly indicate which stock is the best candidate for a short position. It is UAL. If we had shorted the stock or taken a put position in the money $20 put, our result over the next month or so would have been a very handsome profit. Let's suppose that on December 2nd we were more negative about the market than we had been positive on November 19th. Therefore, we might be considering a second short position. That means we would have to choose between Merrill Lynch and Pittston, both of which were indicating the same percentage of downside potential. How might we have made our choice? We could, of course, have guessed, and in this case have come out ahead. But most of the time, guessing will not produce a positive result. Another approach would be to look at the past to see which stock had performed in the most negative fashion. Both issues had made substantial gains from their September lows, but the gain in Merrill Lynch had lagged behind that of Pittston by 6 percentage points. This would seem to make us a better candidate, but be careful. Here we are, looking at 2 stocks, both of which had increased in value by 1/3. How could it be that such strong stocks could be considered as short candidates? Hopefully you have already caught on to the error in reasoning which has been purposely inserted here. Remember, the market is in a trading range, and we're looking for short-term trades. In trying to use the overall gain from the September low, we are taking an intermediate indication and making it the basis for a short-term trade. This will not work. The weakness in these stocks is shorter term in nature. It comes from the upthrusting action that appears to be happening in both stocks. Pittston was the one most decisively stopped by its resistance level. All it could manage was a minor penetration. Merrill Lynch, on the other hand, rallied 2 points above the top of its trading range. Would it be able to do that on its test as well? How high would we have to place the stop to find any meaningful protection? Because of these 2 unanswered questions about Merrill Lynch, Pittston would have been the safer choice. However, in this case, both would have produced a profit. As a final case study, we'll see the picture of the market on Tuesday, February 16, 1982. Here we find the market positioned in what is usually a prime trading opportunity. The low on that day penetrated the support level established by the January low. This created a spring position, which would have to be considered a number 2 spring in view of the amount of volume present. Given this action, we would be faced with 2 options. One would be to take a somewhat larger risk and buy on the spring. The other would be to recognize the need for a test and to postpone trades until that test occurred and had succeeded. For most people, in most situations, the second option would be the one that should be followed. For the sake of this discussion, however, let's assume that we are aggressive traders, willing to take a somewhat greater risk in an effort to realize a greater profit. Before just diving into the market, we should look for other factors that may improve the odds of a positive response to the spring. If they can be found, the risk should not be as great as it might otherwise be. We can find 2 indications that strongly point to a turn to the upside. One is the major divergence created by the OP penetrating its September low, while the wave continued to resist the pressure. The other indication comes from the barometer. Here we see that the technometer had been badly oversold for several days, and that the force and momentum had just turned upward. This marks the point where the market should be most vulnerable to the rally indicated by the technometer. An additional indication can be found in the fact that the market had entered an oversold position on its short-term downtrend. Since we appear to have reasons to expect an advance, our next consideration should be the size of that rally. Here we run into a problem. Since we are not waiting for the test of this number 2 spring action, and since it is the test that actually represents the last point of support and the level from which the count should be taken, we are really left in the dark about the upside potential available at this point. This is reason enough not to act, but we will overlook it because of the previously mentioned indications of an important turn. In actual practice, you would not want to do this because it is an error that could prove to be very costly. Through a combination of some sound and some unsound logic, we have convinced ourselves to buy. Now, we have to find a stock. We want to buy relative strength, so any stock that appears to have broken the bottom out of its trading range could not be considered. Therefore, Exxon, Pittston, UAL, and Union Carbide could be immediately eliminated. The 4 remaining stocks can easily be divided into 2 distinct groups. General Electric and IBM are clearly much stronger than the market, while GM and Merrill Lynch are at best in harmony with it. Therefore, GE and IBM should be given first consideration. In addition to their relative strengths, both have upside objectives sufficiently higher than their present levels to produce a short-term profit. This brings up a point that causes many students a great deal of trouble. There is no question that GE and IBM are the strongest stocks, but it is also easy to see that General Motors and Merrill Lynch have greater amounts of untapped potential. Which is more important, relative strength or upside potential? They are both important, and it would be best to find a stock that has both. When forced to make a choice, however, the type of trade being considered should be an important factor. Since this is still a trading range situation and likely to result in a short-term trade, relative strength becomes the most important factor. You want the stock to move and to move immediately. Relative strength is more likely to provide the momentum to accomplish this. If the market was in a position of having constructively tested a spring action, and we were, therefore, looking for a more important advance, upside potential would become the most important factor. We still want the stock to move, but it is not as critical that the bulk of the move come immediately. Trying to choose between General Electric and IBM would be a very difficult decision to make. Given enough funds and confidence about the outcome of the spring, going into both stocks could be justified. Both stocks are at the same price level. Both seem to have similar objectives. Both have just completed normal corrections and are in aggressive uptrends. In this case, the Barometer and OP indexes do not provide much help either. Neither stock was oversold, although GE was nearer to being oversold, and both were experiencing upward moving force indexes. Neither stock was in divergence with its OP, but IBM was much closer to entering such a condition. Perhaps the combination of GE's technometer reading and IBM's potential for a divergence would have been enough to sway the decision in favor of General Electric, but it would have been a very close call. Every time we pick up a new tool, we must learn first how it works before we can use it with any proficiency. This is true of market tools as well. The new indexes that are now available for your use should be approached in this manner. First learn and then use them. Remember, they are not mechanical gimmicks and will not produce results if used that way. They can be an aid in determining when to trade, and in some cases in determining what to trade. Use them in this manner, and they should prove helpful.